The number is $109,000. That's the income where Medicare starts charging you extra, not because you got sick, not because you filed a claim, because you earned too much. At $153,000, the IRS locks you out of the most powerful tax-free retirement account in existence. At $252,000, they lock the door and throw away the key. And here's the part the retirement calculators don't mention. The same 401k you've been maxing for 20 years, the one you were told is the cornerstone of your retirement plan. It's the thing that will push you past all three of those numbers, whether you want it to or not. You did everything right. That's the problem. The retirement system in this country wasn't designed to fail high earners. It was designed for a workforce that looks nothing like you: lower incomes, shorter careers, earlier deaths. The math was frozen in 1983. Your income kept moving, the rules didn't. And now you're caught in a system optimized for someone else's life, paying penalties designed for circumstances you don't have, using accounts whose benefits dissolve exactly when your career peaks. Here's what I'm going to walk through today. 4 distinct income thresholds where the conventional retirement playbook silently turns against you. Not 1, 4. And they stack on top of each other like traps inside traps. By the end of this, you'll understand why 2 people with identical net worths can retire within 5 years of each other and end up in completely different tax situations, and why the one who followed the standard advice often ends up worse off. The central image I want you to hold on to throughout this entire video is this: a conveyor belt. For most of your working life, the retirement system moves in one direction. Everything you stack on it flows toward future security. But at certain income levels, that belt silently reverses. And everything you've spent 30 years piling up starts sliding back toward the IRS. The tragic part? The conveyor belt doesn't announce the reversal. You only notice when your stack is already halfway gone. Stay with me, because the second trap I'm about to show you is the one that has cost people with perfectly designed retirement plans tens of thousands of dollars without them ever understanding why their Medicare bill tripled the month they turned 65. Let's start with the first place the conveyor belt reverses. You've heard of the Roth IRA, tax-free growth, no required withdrawals during your lifetime. No kidding around, it is genuinely one of the best accounts the tax code offers to human beings who live in America. Here is the small print. The Roth IRA income limit to make a full contribution in 2026 is less than $153,000 for single filers and less than $242,000 for those filing jointly. For the first time since the phase-out thresholds were set, the income ranges pushed meaningfully higher to $153,000 through $168,000 for single filers and $242,000 through $252,000 for married couples filing jointly. Above those numbers, you can't contribute directly at all. The account that builds tax-free wealth for retirement, the one that would have saved you the most money in the long run, closes its door at exactly the income level where you're finally making real money. The belt reversed. You built your career. The reward is disqualification. Now, the standard response from the financial planning industry, and I want to be precise about this because it matters, is the backdoor Roth conversion. A backdoor Roth IRA is a strategy where individuals who exceed income limits for direct Roth IRA contributions can instead contribute to a traditional IRA and then convert those funds to a Roth IRA, effectively bypassing income restrictions. Higher earners may also be able to bypass the income limits with mega backdoor Roth conversions, which shift after-tax 401k contributions to a Roth account. However, not all 401k plans allow this strategy, and there may be tax consequences to a conversion. So the workaround exists, but it requires navigating a second layer of complexity that most people don't know about, including what happens when you already have pre-tax IRA money sitting around, which creates what's called the pro rata rule, which turns the simple backdoor Roth into a tax math puzzle most people solve incorrectly the first time. This is not free money. This is money you're allowed to keep, but only if you understand the rules better than the system expects you to. And by the way, the contribution limit you're fighting to get access to, in 2026, the Roth IRA contribution limit is $7,500, or $8,600 for individuals age 50 and older. $7,500. You're jumping through legal hoops to contribute the equivalent of one car payment per month. The system isn't designed to help you. It's designed to extract maximum complexity while delivering minimum access. Now, I want to tell you about a guy I'll call David. David is 51, makes $175,000 a year as a software architect, has been faithfully maxing his 401k since his early 30s. His HR department gave him a pamphlet at age 23 that said max your 401k and retire comfortably. He did exactly that. He has never missed a year. His balance is solid. He's proud of it. But when David sat down with a tax attorney last spring, he discovered 3 things he didn't know. His Roth IRA was closed to him. His traditional IRA deduction had already been phased out because of his workplace plan. And the 401k he'd been maxing was building the precise financial profile that would cause the most expensive version of problem number 2. The conveyor belt had reversed on him, so gradually he'd never felt the floor shift. But here's the thing about the Roth IRA income limit. It's inconvenient. It's not a catastrophe. The catastrophe is what I'm about to show you. In a few minutes, I'm going to explain exactly how a $20,000 required minimum distribution can turn into $40,000 of taxable income overnight, and why this is a mathematical inevitability for anyone who followed conventional retirement advice. But first, let's talk about the second trap, the one that hits you while you're still alive and healthy and wondering why your Medicare bill looks like a second mortgage. Medicare. You turn 65, you sign up, you assume it costs roughly what everyone said it would cost. The standard Part B premium in 2026 is $202.90 per month. With IRMAA, your total can reach up to $689.90 per month, more than 3 times the base rate. IRMAA stands for Income-Related Monthly Adjustment Amount. What it actually stands for is the government's way of charging you extra for Medicare because of income you may have earned 2 years ago. Read that again. 2 years ago. The surcharge is based on your modified adjusted gross income from 2 years ago. In other words, your 2026 IRMAA liability is based on your MAGI from 2024. The Medicare surcharge in 2026 applies to beneficiaries with income exceeding $109,000 for single filers and married filing separately, or $218,000 for joint filers. $109,000. That number is not high. That is not yacht money. That is the income of a nurse practitioner in a major metropolitan area, a high school principal in California, a mid-level engineer in their mid-40s. And if you cross that threshold in 2024, Medicare is charging you extra for it right now in 2026, based on a tax return you filed over a year ago. And here's the part that makes the IRMAA truly memorable. The surcharge is a cliff system, meaning if your income is even $1 over a threshold, you owe the full surcharge for that entire tier. There's no gradual increase. That single dollar can cost you hundreds more per year. $1, not a percentage, a cliff. You go from paying the standard premium to paying the surcharge for the entire tier with 0 gradual transition. If your income crosses into the next bracket by $1, your Medicare premiums can suddenly jump by over $1,000 per year. If you are married and filing a joint tax return, and both of you are on Medicare, $1 more in income can make Medicare premiums jump by over $1,000 per year for each of you. A married couple, both on Medicare, $1 of extra income, $2,000 of additional annual premiums. The conveyor belt doesn't just reverse, it charges you for the reversal. At the highest income tier, a couple on Medicare could pay over $13,800 per year in IRMAA surcharges alone, on top of their plan premiums. There's also a detail buried in the IRMAA rules that has caught people genuinely off guard. Municipal bond interest that feels invisible on your tax return is very visible to Medicare. Tax-exempt interest from municipal bonds counts toward IRMAA calculations, which surprises many retirees. So you bought munis specifically to generate tax-free income. You're enjoying what feels like invisible income. Medicare sees it. The belt reverses. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now here is a detail about the IRMAA system that I find genuinely instructive about how this whole structure operates. The IRMAA surcharges and Part B premium increases far exceed the Social Security cost of living adjustment. This means retirees receiving Social Security will see their Medicare premiums rise more than 2.5 times faster than their Social Security benefits, potentially reducing their net income. You get a 3% cost of living bump from Social Security. Medicare takes 8% more in premiums. Net result, you're going backwards while feeling like you're staying even. The system is technically not broken. It's working exactly as designed. That's what makes it interesting. The gap angle is always the one that matters. Knowing these numbers and building a system around them are two very different things. I spent months analyzing 50 years of retirement data and distilling it into something I call the exit code, a digital book, 8 chapters of pure research, no filler, built specifically around the mathematical reality that sits between I have a good income and I will not run out of money before I die. The chapter on what I call the $14,000 invisible bill addresses the insurance gap that destroys retirees under 65 who retire before Medicare kicks in. The chapter on the 4% trap dismantles the most widely cited retirement rule in personal finance and shows the dynamic withdrawal method that replaces it one built on actual sequence of returns data, not a theoretical average. The mathematical framework inside turns maybe someday into a specific date, less than the cost of a dinner out through the link in the description. Now back to where it gets genuinely uncomfortable. Let's talk about the 401k you've been maxing, the one the HR pamphlet told you about, the one you've been told is the foundation of your retirement security. I want you to hold on to this. For a certain category of disciplined, high-earning saver, the 401k is a time bomb. Not because it doesn't grow, it does. That's the problem. The average balance for savers who've been investing in the same 401k continuously for 15 years was $617,600. Fidelity's fourth quarter 2025 data show. Good, that's a real number. That's what disciplined saving looks like. Now, here is what happens to that $617,000 at age 73. You generally must start taking withdrawals from your traditional IRA, SEP IRA, Simple IRA, and retirement plan accounts when you reach age 73. These are required minimum distributions. They are not optional. They are not based on your financial needs. They are based on a formula the IRS calculates using your account balance divided by a life expectancy factor from their actuarial tables. Based on that table, a 73-year-old with a $1 million nest egg could be required to take an RMD of around $37,700 in the first year of being subject to RMD rules. $37,700 of income, whether you need it, whether you want it, whether it ruins your entire tax plan for the year. The conveyor belt doesn't ask your permission. RMDs are fully taxable at ordinary income rates, which can push retirees into higher tax brackets and trigger additional taxation on Social Security benefits and Medicare premium increases. This is the domino sequence. The RMD increases your income. The higher income triggers more Social Security taxation. The higher income also triggers the IRMAA surcharge on Medicare 2 years later. You're getting hit in 3 directions simultaneously by money you didn't choose to take. You might be thinking that sounds like a high-class problem, having too much money in retirement. Sure. But think about it from the perspective of 25 years ago. You were told, max the 401k, so you did. Now the IRS is forcing the distribution, taxing it as ordinary income, using it to make your Social Security more taxable, and stacking Medicare surcharges on top. You built the machine perfectly. The machine is now running against you. That's not a high-class problem. That's an engineering failure nobody told you about. Here is the real kicker about the RMD timing. Retirees reaching age 73 in 2025 face a strategic choice in withdrawal timing that could lead to a massive tax spike in 2026. While you have the legal right to delay your first distribution until April 1st, 2026, doing so creates a double hit because the 2026 RMD must also be taken by December 31st. 2026, you would be forced to report 2 distributions in a single tax year. This artificial income surge can push you into a higher tax bracket and may trigger IRMAA surcharges, increasing your Medicare Part B and D premiums. The IRS literally gives you the option to delay your first RMD as a grace period. That grace period is a trap. If you take it, you get 2 RMDs in 1 year. 2 years of required income stacked into 12 months. The belt doesn't just reverse, it accelerates. Now here is where I want to introduce a subplot that will resolve by the end of this video, because it changes how you think about the structure of the problem entirely. There is a financial advisor named Gary. Not a specific Gary, a representative Gary. Gary manages a 7-figure practice, charges 1% of assets under management annually, and genuinely believes he's doing a good job. And in many ways, he is. Gary knows the products. Gary files the paperwork correctly. Gary has not broken any laws and never will. But Gary's business model is built around assets under management. The more assets you have in traditional tax-deferred accounts, the more Gary earns. Gary has zero financial incentive to tell you to do Roth conversions during the gap years between 62 and 73 because Roth conversions reduce the taxable account balance. Gary charges his fee on Gary is not a villain. Gary is an incentive structure. And the advice Gary gives is shaped by that incentive structure in ways Gary himself may not even recognize. I spent 10 years running my own business, surrounded by accountants and fiscal lawyers. The first thing I learned, the single most important thing about how money actually moves, is that you have to understand whose incentives are aligned with yours before you take a single piece of advice. Gary's incentives are not fully aligned with yours. That's not conspiracy. That's economics. And understanding it is worth more than anything Gary will ever tell you. Let's stay with the 401k problem one more level deeper, because you think the RMD is the problem. But actually, the problem is the provisional income formula, and almost no one explains it correctly. There's a concept called the tax torpedo. The real danger is the tax torpedo, a spike in your marginal tax rate. When you are in the 85% phase-in range, every $1 of additional income, such as a traditional IRA withdrawal, makes an additional 85 cents of your Social Security taxable. This means you are effectively being taxed on $1.85 for every $1 you withdraw. In the 22% tax bracket, this creates a 40.7% effective marginal rate, because $1 of new income creates $1.85 of taxable income, 40.7% effective marginal rate in the 22% bracket. You thought you were in the 22% bracket. You're actually in the 40% bracket. Because your retirement account withdrawal is simultaneously triggering Social Security taxation, every dollar you pull from the 401k is being taxed like $1.85. The thresholds that determine how much of your Social Security is taxable, $25,000 for singles and $34,000 for the higher tier, have never been indexed for inflation since 1983 and 1993. More retirees cross them every year. Let me be specific about this. In 1983, when Congress set the threshold at $25,000 for a single retiree, the median household income in America was about $22,000. That threshold felt like it applied to rich retirees. Today, the average Social Security benefit alone is $2,071 per month, according to December 2025 data from the Social Security Administration. That's nearly $25,000 per year before you add a single dollar of 401k income or interest income, which means the tax torpedo threshold was designed to catch the top tier of retirees in 1983. Today, it catches the middle. And you, with your $600,000 401k, are not in the middle. You are going to hit this torpedo at full speed. This is where it gets really interesting, because you've been thinking about this as a tax problem. It's not primarily a tax problem. It's a sequencing problem. The year between when you stop working and when RMDs begin the gap years, roughly ages 62 to 72, is the most financially leveraged period in your entire retirement. It's the window when your income is low, your tax bracket is low, and Roth conversions cost the least. This is when the conveyor belt is paused. This is the moment to reorganize the cargo before the belt reverses. The optimal strategy often involves front-loading Roth conversions in years 63 to 64 up to just below the IRMAA Tier 1 threshold, then reducing conversion amounts once on Medicare to manage the ongoing surcharge. The reason this window matters is compound. Every dollar you convert to Roth during the gap years is a dollar that doesn't generate an RMD at 73. Fewer RMDs means lower provisional income. Lower provisional income means less Social Security taxation. Less Social Security taxation means a lower IRMAA trigger 2 years down the road. One strategic decision at 63 reduces 4 separate tax events at 73. That's not financial planning, that's chess. Now let's run the numbers on a real scenario, because this is where it either clicks or doesn't. Meet Claire. She's 58 years old, earns $180,000 a year as a hospital administrator, has been maxing her 401k since 31. By age 63, when she plans to retire, she will have approximately $1,200,000 in traditional pre-tax accounts. She also expects Social Security of about $2,800 per month at full retirement age, which she plans to claim at 67. Here's what Claire thinks her retirement looks like. She takes $60,000 a year from the 401k, collects Social Security, pays maybe 20% in taxes, lives comfortably. What Claire's retirement actually looks like, run through the actual formulas. Her $60,000 401k withdrawal adds to her provisional income. Her Social Security of $33,600 per year, half of which, or $16,800, goes into the provisional income calculation. Add those together with any other income, and Claire's provisional income easily clears $44,000, the threshold where 85% of Social Security becomes taxable. So she's now being taxed on a significant portion of money she already paid taxes on during her working years. Wait, she didn't. That's the 401k. She deferred, and now the IRS deferred payment is due with interest in the form of bracket creep, IRMAA, and Social Security taxation all hitting simultaneously. Her effective tax rate on that $60,000 401k withdrawal isn't 22%. It's closer to 32% once the torpedo effect is modeled correctly. That's 10 percentage points more than she planned. On $60,000 per year, over 20 years of retirement, that miscalculation cost her roughly $120,000. That's a car. That's a grandchild's college fund. That's 240 months of lost compounding. This is where I want to address something directly, because someone watching this is about to say it out loud. Tom, I'll have a lower income in retirement than I do now, so my tax rate will be lower. Maybe. But here's the thing you're not accounting for. The 401k is very good at making that assumption wrong. Overfunding traditional 401k and IRA accounts triggers required minimum distributions at age 73 or 75. Putting too much money into traditional accounts could lead to taxes on Social Security and higher Medicare premiums. The account you max for 30 years generates mandatory income, income you didn't choose, income that doesn't respond to your spending needs, income that the IRS schedules for you. And the IRS schedule doesn't care that your mortgage is paid off. It cares about a life expectancy table last updated in 2020. Now, here's the number that anchors all 4 of these traps together, because the irony is almost elegant. The magic number Americans think they need to retire comfortably in 2026 is $1,460,000. That's the number people are aiming for. That's $200,000 more than the figure from 2025, and it's still far from what most people have. The median retirement savings for those aged 55 to 64 is $185,000. So there's a gap between what people have and what they think they need. And in the scramble to close that gap, the instinct is to put more into the 401k, which creates more of the problem. The solution looks like the problem. The conveyor belt reversal becomes a conveyor belt acceleration. Stay with me, because I want to tell you the most important thing this conversation leads to, which is not about what accounts to use. It's about sequencing. There are 3 levels to thinking about this problem. Most people are stuck at level 1. Level 1 is the account level, which accounts exist, what the contribution limits are, how the tax treatment works. That's the HR pamphlet. That's the financial press in January every year. Max your 401k. Contribute to your IRA. This is necessary knowledge, and it's not sufficient. Level 2 is the interaction level, understanding how each account type affects the others in retirement, how a 401k distribution affects Social Security taxation, how Social Security timing affects IRMAA, how IRMAA thresholds affect Roth conversion sizing, how Roth conversion sizing affects future RMD amounts. This is where most sophisticated savers think they are. Very few actually operate here. Level 3 is the sequencing level, understanding that the decisions you make at age 62 set the conditions you face at age 73, which set the conditions at 80. Each window has a leverage factor. The gap years between retirement and RMDs carry the highest leverage of any period in your financial life, and they are finite. Once you start Social Security, once you cross into Medicare, once the RMDs begin, certain options close. The belt is moving. You can't reorganize the cargo while the machine is running at full speed. Which brings me back to Gary. Gary, our representative financial advisor, is managing the assets. He's watching the account balances. He's rebalancing the portfolio. What Gary is almost certainly not doing is modeling the sequential interaction of your 401k balance with your Social Security claiming age, IRMAA exposure, and provisional income threshold. According to the Tax Foundation's 2025 analysis of retirement income sources, retirees with tax-diversified portfolios pay an estimated 18 to 22% less in lifetime taxes than those concentrated entirely in pre-tax accounts. 18 to 22% less in lifetime taxes. That is a massive delta, and it comes almost entirely from decisions made in the gap years. Gary's not usually talking to you about the gap years. Gary's talking to you about your equity allocation, which is fine, but it's level 1 thinking while the money is being lost at level 3. This is where the instinct says, okay, so I should move everything to Roth now. Not so fast. Because every dollar you convert to Roth is a dollar of income in the conversion year. And if the conversion year is a high income year, if you're still working, if you had a bonus, if you sold a business, the conversion tax cost can actually exceed the future benefit. The game is not Roth good, traditional bad. The game is which dollars, in which year, from which account, in what order. If you hold both traditional and Roth accounts in retirement, you can choose which to tap each year to manage your taxable income staying within a target bracket, avoiding Social Security taxation thresholds, or managing Medicare IRMAA surcharges. That's the play, not the account choice, the sequencing, the annual calibration of your income to stay below the cliffs without going so low that you're leaving tax brackets on the table. Now here's where I want to pause and give you something comedic, because if I don't, this video is going to feel like a tax code audit. The advice most people got in their 20s was essentially, put money in this account. The government will give you a tax break. Thank you for your participation. And then 40 years later, the government says, great news, your tax-deferred account is now worth $1.2 million. Here's a check for $37,000 you didn't ask for. By the way, that check has now triggered extra Medicare premiums, made 85% of your Social Security taxable, and pushed you into a higher bracket. See you next April. It is genuinely impressive. The other one, a married couple asks their financial advisor about Roth conversions. He says, you might not need it, you're in a low bracket now. They come back the next year. The 401k has grown 14%. Now they're being told to convert more. The bracket grew faster than the advice did. The conveyor belt moved while the advisor was reading the menu. Back to the practical. 3 specific things you can actually do with what you now understand. First, run your IRMAA exposure before you retire, not after. The 2-year look back means your Medicare costs in the first year of full retirement are based on your last year of full employment. If your income dropped when you retired in 2025, your 2026 premium is based on your 2024 income the year you may still have been working full-time. Form SSA 44 is designed exactly for this situation. Most people don't know it exists. You do now. File it if you have a qualifying life change. The approval rate for legitimate events is high. Second, Understand the gap year window and use it with intention. The best time to manage the tax torpedo is before you claim Social Security, typically in your 60s after you stop working. But before RMDs start at 73, you are in a low tax bracket. This is the prime time to do Roth conversions, paying a low tax now to create tax-free income for later. Size the conversions carefully. Stay below the IRMAA Tier 1 threshold of $109,000 for single filers if you're already on Medicare, and below the next tier if you're approaching it. Third, model the provisional income formula before you decide when to claim Social Security. Every year you delay Social Security past your full retirement age adds 8% permanently to your monthly benefit. If you delay your claim beyond full retirement age, you receive a delayed retirement credit for every month of delay, up to age 70. Waiting one extra year beyond full retirement age gets you 108% of the primary insurance amount for life. Waiting a second year until 68 gets you 116%. A higher Social Security benefit, however, is a higher provisional income input, which means more potential tax torpedo exposure. You need to model both sides, the delay benefit and the provisional income impact. These are not separable decisions. Gary almost certainly isn't doing this modeling for you, because Gary's fee is on the assets, not on the tax efficiency of the withdrawal sequence. Which brings me to the subplot resolution. Gary is not malicious. Gary is a product of a system that measures the wrong things. The financial advisory industry measures assets under management. The tax system measures income in isolation. The Medicare system measures income from 2 years ago. None of these three systems were designed to be looked at simultaneously by the same human being trying to build a coherent retirement plan. They were built at different times by different agencies for different purposes. The collision between them is the problem, and navigating that collision is the actual work of retirement planning, not picking mutual funds. The real insight here isn't that you should be afraid. It's that you should be precise. The conveyor belt reversal is real, but it is navigable. The traps are real, but they have warning signs you can see if you're looking at the right instruments. The gap years are finite, but they exist. The window is open right now for anyone in their late 50s or early 60s who's paying attention. You know what never reversed the conveyor belt on me? Index funds in a taxable brokerage account held for decades, with careful attention to when I realize gains and what bracket I'm in when I do it. Not the flashiest answer. Not what gets engagement on finance Twitter, but the compounding math on a simple, low-cost, tax-managed taxable account supplemented by Roth contributions during the years I qualified, and Roth conversions. During the years IDON'T has consistently outperformed the over-engineered strategies with 15 moving parts that generate fees every time you rebalance. Lazy investing built more fortune than crypto memes. And the retirees who got hurt weren't the ones who didn't save enough. They were the ones who saved exactly the right amount in exactly the wrong account structure and discovered it too late to do anything about it. Don't be precise about the wrong things. Be precise about the sequence. Be precise about the thresholds. Be precise about the 2-year look back. Be precise about which window closes first. Everything else is just math you can learn in an afternoon. The conveyor belt is running. The only question is which direction it's moving